Good afternoon, welcome to Market Wrap number 126. Stuart Williamson here at the helm. Now, the idea of doing this is just to give everyone a bit of an idea as to what's going on in the UK market as far as we see it. If you like it, please do so, subscribe, look at our podcast perhaps, download our call to arms at the end, register for more information, all those sort of things. We do this every week. As I said, this is number 126. This week, James Lang LaSalle just recently released their 2022 final quarter predictions. Now, no doubt this will create a large amount of comment, especially from those who are the end of the world people, the nigh, end of the world is nigh, those sort of types. They'll be saying things like, you're a simpleton, Williamson, you're selling property, you're bound to sell it up, you're in the game, you've got axe to grind, all those sort of things. But this report has got some good grounding and some merit. The full report is going to be end, and there'll be plenty of charts here to look at. Now, the last 15 years has seen the UK housing prices reach record new highs on a period of low borrowing costs. Never prior to 2008 had the UK base interest rate dipped below 2%, but in the period since the global financial crisis, it has averaged 0.5% and hit a low of 0.1% during COVID. There's now a spike in borrowing costs that we're going through at the moment, and anticipated further steep rise in those, alongside continued high inflation and a rising cost of living, have prompted predictions that the end is nigh, with many bearish forecasters saying 20 to 30% falls in the UK house prices. A gentleman last week said 40% at least. Fair enough, we're all got our own opinions. But according to James Lang LaSalle, UK house prices have never fallen by more than 20%. And this prompts a question whether the underlying market prospects are now truly worse than the early 90s recession, where house prices fell by 20% between 1989 and 1993, and the global financial crisis, where prices fell by 15% between January 08 and May 09. Now, historic interest rates and mortgage rates in the early 90s, plus inflation was high, like it is today. GDP was low, like it is today. But a key differentiator was that unemployment was extremely high at that point. 10% in the early 1990s, whereas today it's at a record low of 3.5%. Okay, that's not necessarily good unemployment. There's a lot of negative Brexit stuff in there. But when unemployment is expected to rise over the coming 18 months, it will probably only reach 4.9% according to the ONS, below the average of 6.7% since 1971, and the past 10-year average, which is 5.2%. Meanwhile, during the global financial crisis, that was fundamentally a credit crisis built on poor lending practices throughout the early 2000s, which saw people with poor credit history and no equity lent sums of money they could ill afford to repay, and that's why you had so many recessions at the end. It turns out they couldn't afford to pay it. Yeah, he was actually right. James Lang LaSalle say there's not a lot of distress in the marketplace. There's not a lot of pain at the moment. They have analysed the Bank of England mortgage and lending report and found that 62% of the UK's 8.4 million mortgaged owner-occupied households have at least 25% equity in their home. Another 34% have between 10 and 25% equity, and 4% have between 5 and 10%. There's just 0.2% or 17,000 owner-occupied households in the UK with less than 5% equity. And statistically, which we all know can be made up on the spot, there are no households with zero equity. Meanwhile, more than 95% of the circa 3 million buy-to-let landlords who own with a mortgage own at least 20% of their property. But at the end of the day, the amount of equity the UK homeowners possess only tells half the story, isn't it? You know, with the era of cheap borrowing ending, mortgage affordability is going to be squeezed, and it's starting already. You know, mortgage households in the UK have highest incomes by tenure. Okay, so people who have the mortgages earn the most, averaging 80% per annum. Before the recent rise in UK interest rates, the proportion of average household income spent on mortgages was equivalent to 18%, with the average 2-year fixed rate mortgage cost having risen to close to 6%. That income to mortgage expenditure percentage has, in theory, risen to around 27%. And that is the level it was around the time of the global financial crisis. Now, if the rates go up as far as 7%, which is probably a bit toppy, it's more likely to be 6.5%, 6.25%, house price crashes have been rare in the UK. The average household income to mortgage cost ratio would hit 30% if it went at 6.5%, the rate it was at in the early 1990s. But merely spending 30% of your household income on housing costs is not a reason to assume the end is nigh, or a collapse into distress is about to happen. With low unemployment and the highest average incomes, the UK's mortgaged households are on a far more stable financial footing than were in either the GFC or the early 1990s recession. The vast majority should be able to ride out the squeeze on their household incomes, avoiding the need for a fire sale. I mean, that's potentially true. Okay, you can go for a further extension on this cost of living crisis argument and say around 1.1 million households are currently on a standard variable rate coming to an end this year. Another 1.2 million will come to an end of their fixed term over the next year. And JLL have calculated and suggest that these 2.3 million households combined will be spending an additional 8 billion on mortgages by Q4 2023. Now this, contrarily, would ease some of the current high inflation issues, but it would also potentially hamper GDP growth, which, as we know, the UK has got the worst of the G7 post-COVID due to the Brexit situation. The customers' extra spending, instead of going into disposables or savings or investments or leisure and entertainment, would go into their mortgage instead. So that would reduce inflation. So what about if we get into that scenario and people are starting to be repossessed? Is there a high risk of that occurring or not? Obviously, each individual situation is a personal situation, but the banks at the moment have got a very low appetite for repossessions. In the early 1990s, banks repossessed over 100,000 homes per annum because they've been lent money ridiculously by banks. So it's just banks that cause the problem. In the GFC, the rate was about 50,000 per annum. Again, poor lending practices. Currently, there are 4,000 repossessions per annum, which out of the UK's approximately 11 million mortgage properties represents a rate of about 0.04% per year. Now let's look at the mechanics of it all. It takes 2 years to repossess a home, and in the current cost of living crisis, it would be deemed pretty unpolitically correct to have that public position that you are adopting a repossession strategy. You know, however, banks are regulated entities, so they can't just ignore it. They have to do something about it. But as during COVID, and during COVID, I took advantage of going onto an interest-only mortgage myself at one stage because we weren't sure what the future would hold and how long it would go on for. So I just thought I'd try and do that to save my stress about the future. You can also go on to tracker mortgages as opposed to fixed rates. So basically, JLL are saying that banks won't be so aggressive in foreclosing because they don't want to bankrupt the property any more than the people who own it. They expect to be far less distress, therefore, in the market than any other previous downturns. As long as there's no sharp rise in unemployment, then it should be okay. But they do predict that there's going to be a steep fall in housing transactions. And basically, this is all about first-time buyers. Before the GFC, first-time buyers, FTBs, were 400,000 per annum out of a total 1.5 million annual transactions. Post-GFC, FTBs fell to 325,000 in transactions, 1.2 million. JLL are predicting it now be circa 200,000 first-time buyers. So it's going to be aspiring homeowners are really going to take the hit. Mortgage affordability is really going to punish them. And with the end of Help to Buy, which was apparently helping 50,000 people a year to get onto the market, those things are going to knock it on the head for them. So a cocktail, as they call it, the cocktail of transactional headwinds will see an overall transaction fall to circa 1 million in 2023. The transactions that do occur will be dominated by slightly more motivated sellers, but not financially distressed, faced with a higher proportion of opportunistic opportunity buyers, i.e. people with cash who want to just go out there and try and mop up some bargains. And we've seen heaps of this already. People saying, will there be bargains around next year? Shall I keep my cash? It's worthwhile keeping some of it, but I think the bargains are going to be out there and going to be pretty thin. We'll get onto that in a moment. We'll just look at where are these 6% falls going to occur. JLL are saying that UK house prices will fall in value in 2023 by 6%, which equates to an average of £17,500 per UK house. However, and they're very specific on this, they say not all types of home, cities or regions will be impacted on the same level. On a regional level, JLL forecasts falls ranging from around 4% across Greater London to 8% in Wales, the North East, Yorkshire and the Humber. However, many of the housing supply constrained UK city centres, where there's a greater concentration of equity-rich buyers, price growth is still expected to be strong. And there's a key to it. I think the end of the flight to the country, people returning back to city centres, especially eco-friendly city centre homes. In addition, new housing supply is expected to fall even further behind target as a result of tightening market conditions, the government doing away with its new home build target of 300,000 a year. JLL is forecasting there will be a national shortfall of 610,000 homes over the next 5 years alone, up from their previous expectations of 500,000 home shortfall. In London, private new home starts are forecast to average 16,000 per annum, which is well below the GLA's, the Great London Authority's, 52,000 target. Now we'll just talk about strong rental markets out there. They say the persistent lack of quality rental housing is an ongoing issue for the UK, highlighted by the recent rental growth and students and renters struggling to find accommodation. The fundamental demand for quality rental housing stock is remaining at unprecedented levels and is reflected in ongoing strong institutional investor appetite for purpose-built rentals. And we're seeing a lot of these purpose-built rental homes, blocks being bought for that, so that there's not much for the private person to buy. It's more the big institutions coming in like pension funds and buying it. Annual investment in UK living real estate sectors, okay, if you understand what that means, has exceeded 10 billion in the third quarter of 2022. That's going to be the highest it's ever been. So buy to rent, the highest it's ever been. This ongoing strong investment has funded 63,800 rental homes in over 200 deals so far in 2022. The current supply-demand imbalance across the UK rental market is going to carry on as fewer households move across their own occupation and they stay in rentals because they can't afford it. And so we see rental demand going up. We expect that prospective buyers, as well as those who would under normal circumstances have transacted Help to Buy, will remain in the rental market, they say. So it's an already constrained rental market, and it means that the supply-demand imbalance is going to get even worse. So we're going to get strong rental markets, meaning that rental growth, actually the yield will continue and the demand will continue. So buy to let is still going to be a good market, not including the tax situation. They expect the rental demand will be very strong over the next 5 years, falling back then to probably 2 to 3% as inflation is brought under control later on in the 5-year period we're looking at. I mean, this is a drum I've been banging for a while, and I know I'll get criticised for it. You know, there is negative parts of it. You know, the cost of debt, you know, may have a knock-on effect for landlords, maybe too expensive for them. The cost of, you know, the HMOs, the cost of all the electricity bills and so on, that's going to be difficult. You know, so there are going to be difficult times ahead for individual landlords, but the buy-to-rent sector from an institutional perspective is looking very strong, and that is a good investment area where you as an individual can buy into that. They say the outlook for the UK city centres is much stronger than the outlying areas. House prices are still expected to grow in the centre of many of the UK's largest cities, Central London, they predict, will see the highest level of house price growth of any UK housing market in the 12 months up to Q4 2023, with values expected to go up by 2.5%. It's going to be driven by the shortage of homes, but also the weak pound. You've got the exclusive markets in London, you get all the Chinese, Russian, Middle Eastern buyers coming in to buy, and the weak sterling will underpin that price growth. They then expect prices in central London to steadily rise over the 5 year to the end of Q4 2027, with a cumulative price growth of around 20%. Across London as a whole, the continuing and long-running housing undersupply is expected to worsen. JL's research forecasts that construction will commence on just 83,000 new homes over the next 5 years. Okay. Other city centres that will outperform London, other city centres which won't outperform London are locations such as Birmingham, Manchester. They're second on the list. I mean, last week we spoke about it. In Manchester, a studio now rents for what a 2-bed flat rented for 4 years ago. So we're looking at very strong markets in Manchester and Birmingham. We're looking at strong markets in Edinburgh and Bristol, where all these places have good, ties, as we call them, transport, infrastructure, employment. They've got reasons to grow. Basically, you've got in places like Manchester and Birmingham, they both claim to have the most stay-on students after they've graduated, and that is a big thing. They do have a lot of students who stay on because it's a great place to be. JLL suggests that energy-efficient new build city centre homes are expected to prove very popular because that can cut the cost of energy bills, and basically that we will just get a strong growth in city centres. Manchester city centre is one of the fastest growing economies in the UK. It's truly, with Media City, Salford Quays, HS2, the Northern Powerhouse, they expect then to see the strongest rental growth over the next 5 years as more and more young professionals are attracted to go and work there. You've got the same situation in Birmingham. You've got HS2, you've got the levelling up agenda, you've got the new Media City going in, Mercian Studios. You've got many, many positive factors going on. So that's really the gist of the report. Below is a link to the actual report itself. You can have a look at that. There's also our call to arms where you can fill your information in and ask more details on what stuff we're doing. Do like, please, if you could, subscribe, and hope you enjoyed it. Take care. Bye bye.